The difference again, eliminating the 20-year issue with the pooled income fund, is that we have, and what's unique is you can do multiple generations of income, is now you're doing something for the community. Now you're doing something for your favorite charities, but you're also deferring the taxes.
What else that you think might be helpful for people who are looking at the DD for the first time, and it might be like a question that they have or a concern?
I'll talk about a complement to the deferred sales trust that I think is incredible. And so you think about the deferred sales trust, you've got your $10 million asset, you moved it out, it's sold. You now have a carryback, you have a note, you're collecting, let's say, $500,000 a year in income. And instead of having 6.2 million, you got 10 million. And it's really just an incredible situation. But imagine complementing that with I've talked to Brett about the benefits of a charitable remainder trust. And the charitable remainder trust is really nice because you can also defer the taxes. You can also collect income of a similar amount. And so if you split it or did 80, 20%, whatever, you're going to have the same income, the same tax deferral. However, the difference is at end of your life or 20 years later, the charity is going to receive those assets. Now, for 20 years later, that's really a challenge for me. It's unfortunate because some of my clients are 50 years old when they do this, so I can't imagine having their assets disappear at 70. So another option is the pooled income fund. And so the pooled income fund is a very similar vehicle under different IRS rules, but it allows you to, we have partnerships where we can take a business asset, LLC shares, C Corp, S Corp. We can put assets into a pooled income fund. They get a tax deduction that's usually twice as much as the charitable remainder trust. That money gets reinvested in a pool of income creating investments. And right now, that's typically paying out a little over 6%. So they get 6%, 5 to 7, nothing guaranteed on the income, but they're getting 5 to 7%. And that will keep paying out to them and can even keep paying out to their children. And at the end of that next generation, the money goes to your own charity, your favorite charities, or your donor advised fund. So in both vehicles, we get to defer the capital gains. In both vehicles, we get income creation. The difference, again, eliminating the 20-year issue with the pooled income fund, is that we have, and what's unique is you can do multiple generations of income, is now you're doing something for the community. Now you're doing something for your favorite charities, but you're also deferring the taxes, collecting income. And my favorite part of this is you're getting a nice size tax deduction that you can use to offset all the income taxes that you'll be paying on the income that you're collecting from your deferred sales trust. So that's why I would say these complement each other. Is when I'm receiving a interest on the note as a seller and having my assets in the deferred sales trust, I got to pay income taxes on that, which I'm happy to do because my interest is much higher than if I would have just sold it outright and pay the taxes. But now I've got a tax deduction for 5 years that's offsetting a lot of those taxes. And so depending on how much you put in there, that can be worth $400,000, $500,000, $600,000 in your pocket of less tax cost. And so the deferred sales trust is an amazing vehicle, but I do see it as like a core strategy with satellite strategies that complement it that can help tax flow much better.